Good day. This is the Elliott Wave Weekly Update for the NASDAQ 100, being recorded on Saturday, December the 14th, 2024. It was an interesting week for the NASDAQ 100 as we continued to see a rotation in and out of the Mag 7 stocks, and we continued to see a very high level of volatility as measured in the options, not necessarily in the VIX. But what that higher volatility in the underlying did suggest is that the market continues to load up on risk on type trades. And that is where they're selling volatility via the VIX and then buying the volatility via, such as Apple, the Mag 7, basically. We continue to see very high volume in the stock, particularly in NVIDIA and also in Tesla, as both of those stocks, NVIDIA is struggling to keep itself back above 140, and Tesla pushing and reaching up, I think, as high as 430 thus far, $430. We're seeing as well as an increase in movement in Apple, and that may have a lot to do with Friday's expiration, and we'll see what happens from that from here, moving up to December the 20th, which is our next quarterly, monthly, and triple witching expiration, and that is on Friday, December the 20th. That's also showing up as being an extremely heavy call weighted expiration. In other words, a lot of these positions, a lot of the gamma that's coming in is in calls. And that would be in the SPX, that would be in the ETFs, that's going to be in the individual stocks. We're just seeing a great deal of calls. Now, that could just be a setup that that's the way they're doing it, and they're all going to take delivery of the underlying, the stocks, and be long at these various strike prices, particularly in NVIDIA. I'm seeing a lot of like the lower, well, now they're lower strikes, but like the 115, the 120, the 122, 125 are still very heavy in open interest. And so they all expire on the 20th. So it's going to be an interesting week. And I do believe that the volatility is going to remain up through likely December the 20th, that expiration. We might see after that where we get an expansion in volatility via the VIX, simply because all this gamma has been released, which also sometimes does present us with what appears to be a suppressed volatility that we see via the VIX, where the market may shift and head lower, but the vol really does not necessarily get hit. And when the market moves higher, the volatility does not necessarily get hit as hard. So it's kind of an interesting situation. And I think a lot of it is because of how we've always felt and dealt with VIX being the fear gauge. It would be fearful, the market would be fearful of a decline if we started to see, volatility start to creep up, or during a heavy decline, volatility would just spike higher. And that still, I think, is going to happen. It depends on the situation that's going to drive that spike higher in vol. So if it was a situation where something geopolitically happened and it was serious enough and it was dangerous enough, then volatility would spike immediately, versus that it's just going to continue to go higher, progressively higher, as a market were to sell off, let's say. In the meantime, where we are seeing this volatility is in the underlying stocks, and that's being measured by the options flow. So flows, I should say, and there still is a lot of capital sitting in these calls that are going to be expiring across the board now. That's indexes, ETFs, and underlying. That a lot of call positioning is already there. So it's going to present us with an interesting situation as we go through this next week. So having started by saying all that, I'm going to jump into the NDX, which is the cash market. I'm here on the weekly. I just want to give a review over what I believe the market is still involved in and what we're finishing and what type of a correction I'm looking for and why. So right now, over what I have labeled, the largest degree that I'm counting that's visible is a primary degree, and it's a primary degree wave 5. And it started in October of 2022, remains in play right now. In fact, what I believe that we're in, so let's do the countdown from starting from primary wave 5 will consist of 5 waves of intermediate degree, of which 1 and 2 are complete, and we're now tracking and getting close to what I am determining is going to be the intermediate third wave, the completion of the intermediate third wave in the NDX or in the NASDAQ 100. That will lead us to an intermediate fourth wave correction. It'll be an ABC correction down. And I believe that we're likely going to reach above 22,000 before the NASDAQ completes this third wave. So what our initial showing is, if indeed we are completing an intermediate third wave, looking for an intermediate fourth wave, Elliot has taught us that a fourth wave will normally find its terminus, its endpoint within the price territory and towards the low of the previous fourth wave of one lesser degree. Since we're counting up towards a completion of an intermediate third wave, so the fourth wave of one lesser degree is going to be the minor, and that's this one sitting right here. And that low, which completed minor 4 on August the 5th, 2024, was at 17,435 here in the cash. And that remains in place as where we would be looking for intermediate wave 4 to complete. Now, does it say that it has to, by a golly, it's got to finish right there at that point? No, not necessarily, because what then comes in, as we've seen, when I've shown some test patterns, let's say, on where I think wave 3 will finish, and then where those support for intermediate forward come in. And right now they continue to suggest between a 382 and a 50%, and they wrap themselves around this lower end here. So again, we may see it be greater, and that wouldn't surprise me, but our initial balance shows us that we should at least work our way back to 17,435, 450, around in that area, as we look for the formation of this intermediate fourth wave. Now, having said that, there are some folks who may be counting a little bit differently, or not necessarily using Elliott at all, and their feeling is that we are moving ourselves towards, and we're getting signals that the market will slip into a recession in 2025. And that's very possible. Who's going to say yes or no that it definitely can't or it definitely will? I think that we don't have that information. I do believe, though, that with the advent of the algorithms and with the massive amounts of capital we're seeing being traded in ETFs and in the options markets, that's truly dictating direction more than being bullish or bearish, or more than what a fib may suggest, more than what signals in terms of we're heading into a recession because this has happened and this has happened, or as other tools that have been used previously in prior years and prior decades to signal that the market is due for a larger correction. And part of that comes from our treasuries and how they're being marked and what we're seeing happen with interest rates. And so, but I think that the premise is sound, and I don't have a problem with it. But I believe, in my view, what we got coming is an intermediate fourth wave followed by an intermediate fifth wave. And it's from that intermediate wave 5 high where I'll see the completion of primary wave 5. And then also one up from that would be a cycle third wave. So we would then be indeed looking at a cycle fourth wave, which those of you that have followed me long enough, you'll remember that in January of 2022, I had felt that high that we got then completed primary wave 5, and cycle wave 3. And I thought we were starting to tumble down in a cycle fourth wave. And that was projecting much lower than we eventually got. And the turn, which took us much higher than I thought a uh, primary degree corrective phase to complete a cycle degree corrective phase should have gone. And so that's why things got shifted, and where it was primary wave 3 that finished in January of 2022, and then it was primary wave 4 that finished in October of 2022. Now, granted that was faster than I would have anticipated a primary degree to finish, but nonetheless, it did. And because we can witness that by just the strength that the market has had since that point, and the fact that we've superseded all of the irregular B wave measurements that we would use to suggest that it was inside this, that it was an intermediate B wave up, and that's what we're finishing now. It's just gone too far. It's gone too high. And so therefore I am marking October 2022 as the completion point for primary wave 4. And we remain within a primary third wave of, a primary fifth wave, of which we're close to finishing intermediate wave 3. So having said that, what's inside of intermediate wave 3 are 5 waves of minor degree, of which we have 1, 2, 3, and 4 is complete. We're inside minor wave 5. Let's come down off of that. Let's go to the daily chart, and we're going to take a look inside this wave. And what's inside of minor wave 5 are 5 waves of minute degree, of which we have 1, 2, 3, and 4, and we're inside that fifth wave on minute wave 5. And what's going to be inside of minute wave 5 is 5 waves of minuet degree, of which we have 1, 2, 3, and 4. In my view, complete. And so we're inside minuet wave 5, of minute wave 5, of minor wave 5, of intermediate wave 3. So that's how close I think we are to getting ready to start a larger correction than what we have seen since July, August of 2024. In fact, I expect it to bring it back to the area of the lows of minor wave 4, which it completed in August the 5th of 2024. So now we're going to drop it down again, and I want to bring it into our hourly chart, because my focus really just kind of, well, let me go out to the 4-hour chart so I can get it all. So we're just looking to what's inside here. And basically what I want to do now is I want to take a look inside of this minute fifth wave. And that's why I'm coming down to my hourly. And there is minute 4. It should be right there somewhere. It's always got to be something with these charts. One day off. So there's the 4. Okay. So there's the 4 there. We're working on the hourly chart. Minuet 1, minuet 2, minuet 3, minuet 4. So we're presenting ourselves with, in the NDX, similar to what the SPX was telling us. It's not the easiest count. We had a gap down followed by a gap up just in a matter of days. And so that was presented us with some interesting suggestions or just thoughts on what the market is attempting to do. When we look at the futures market, of course, that's all filled in, as this was all filled in, because the future trades while the cash market is closed. So nonetheless, what I've determined is that we've done the first wave up within minuet wave 5. Initially, I thought maybe 1, 2, and there was a 1, 2, but then I thought, no, I still have, like the SPX and the S&P, the ES, still needing to put an additional low in before they're going to be ready to really start to charge higher. So I attempt to really not do it on purpose, but I like to try to keep both the S&P and the NASDAQ kind of in cahoots with one another in terms of their Elliott wave counts. I try to get the labeling as close together as I can, because it's the same 9 or 10 stocks, high tech stocks, that are in control of the S&P that are the same ones that are in control of the NASDAQ. And sometimes also we can toss in the Dow, although the Dow has a lot of only 30 stocks, but it has others that are representative of the broader market that will take control over. But when we, Apple and Microsoft, and I believe whatever replaced Intel might be the in the Dow. I'm not sure what they replaced it with now and it just came into my head and went out of my head. So we're just going to move on. So how I'm looking at this right now is that we finished wave one. We're still needing the completion point for a wave two, which is going to be an A, B, and then we're still looking at a C wave. And so what I got going on is on here, this side, these are for the second wave. And then these two are for the C wave. And we're seeing that they match up with pretty much we're between the 50 and the 62% retracement level at where wave C would be equal to wave A, and that's at 21,564. Now, if that holds and it stays and takes care of that 50 right there and hold on to that 50, then I can put a 2 there and be looking for this rally to really kick in and start to go. And then I'll have additional fibs, which will beginning to line up. Where inside here are we going to end up, or even higher? So right now I'm continuing to look for the NASDAQ to get itself back above, not get itself back above, but to get itself above 22,000, possibly even 23,000 before all is said and done. We saw some very strong gap higher, and this would have been on the 13th. So we gapped up strongly on Thursday. We gapped lower on the 12th, then rallied. So it's again strange pattern, and again it's truly because of the capital flows that are coming in and out of Tesla, in and out of Apple, in and out of Nvidia. One day they love it, then the next day they don't, and we're just seeing capital move. And it's a lot of volatility as well. I continue to tell you that the options are traded very, very, very heavily. And as an ex-market maker, which are now they're called dealers, when you have someone whose their job and the computer's job is to produce a market and all of the options of a particular stock or class, then they're also that computer is going every time that they have to sell a call, they're going to buy the underlying. If they're buying a put, they're going to buy the underlying as a hedge. And we can see when those hedges get turned and when they're able to then buy back the call and sell the stock. And so we see these types of moves happen. And even though they're hedged, it's like they're lifting the hedge, they're changing the position. But this is really what fuels a lot of our moves, of course, is the intensity and the number of calls. Now, again, December the 20th, it is I believe it's a triple witching, but it not only is the monthly, but it's also the quarterly. It's the quarterly expiration. And the actual end of that quarter expiration is, of course, December the 31st. But for stocks, for the underlying, then it is the 20th. There are 0 DTEs in the SPX and in the ES and in a lot of the ETFs that will expire on the 31st. But the individual stocks, I do not believe, have a 31st expiration. So December the 20th. Now this expiration on December the 20th is extremely heavy duty calls, call positions, lots and lots of call positions. In fact, it is the heaviest we've seen. So what does that suggest? To me, I was thinking I want to see what these reads are going to be coming Monday because a lot of that gamma likely came off because it was shifted and placed on the December 13th expiration. So what happens there is they have expired. So they're off the board. That releases gamma. That kind of gives a volatility pop, number one, but also gets the market to probably release a lot of that pent up energy and we come down a little bit. And I'm thinking that fits perfectly because we're looking for a completion of a small second wave. So we're sitting in a decent position where it's like, okay, as long as these uh, support levels hold and we get 5 out of this drop, 5 waves, then it's going to be pretty clean, in my view, that we should continue the rally. Now, that may take all of Monday to get down there or part of Monday to get down there, and then we start to go. Now, don't forget we have a full week, and then the week after that is a holiday shortened, and trust me, I think it'll be very short because Christmas is on Wednesday. So we might have a lot of people that come in and do what they need to do on Monday, maybe Tuesday, but they're going to be heading out. They're going to be heading out. And so we go from there, to be honest with you. Okay. So back to the chart. What I'm essentially going to look at to start our week is for this completion of this small wave two. So we closed out at 21,780 in the cash, 21,763, I believe it was, in the futures market. So again, we should, depending on how they open it tomorrow in the Globex session, I think we should head lower. And our markers again are 21,564, 21,415. Those are for the C wave as a part of wave two. If we're just looking at wave two as a whole, then we're looking at 21,600, 21,532, and 21,436. And we've already gone through that one, so I just want to take this off right now. So if you come back later and you go like, hey, what happened to that 0.382? It's already been exceeded, so I'm taking it off to clean it up to look at where C fits with both of these levels and how this C wave fits with this level pretty cleanly. And what wave two can't do is it cannot go below 21,299, I think it is, but actually it's 21,313. That is the low and the starting point for this wave one. So it cannot go below it because then it's not a wave two. So I believe that's going to happen, and then we'll start to rally again. Now, what I'm going to need is some additional markers for when wave two is done, and I can put some estimates on what this sub minuet wave three is going to be for minuet wave five. Straight out, minuet wave five has 100% where 5 would equal 1 at 21,996, 997, and basically 22,000. So I'm already believing that we are going to get ourselves about 22,000. Now, here's one more thing, and I will talk about this in more when I get to the futures market, that future is going to shift. The future, and I'll talk about that just in a minute. But here we have where this is an intermediate wave three, should find resistance. It's 662% of wave one at 22,092. I feel that since we're just finishing a smaller wave one here, that minuet wave five is going to exceed that level. So when we're looking at it, it's going to come down, as I say so often, that we're in that minute wave five. As soon as I'm clean on the 5 waves up, it's not going to matter because it'll finish, but whether it finishes here or whether it finishes here is yet to be determined. But this is just a marker to show the extent of how far this intermediate third wave has gone and where that 6.618 is located. The next up on the line would be 7.882 or 7.618, which comes together with also a minor degree, and that's at 23,800. Can the market get up there? Yeah, actually it can, folks. If we get just a dynamic push this next week, and then they continue to take it to end of year, yeah, we could end up here in the stratosphere even further. But it does not necessarily change how I'm viewing the market in terms of it being an intermediate third wave. But where it all lands off, I mean, we're definitely in a blow-off style here. I will say that as well. Okay, so in the cash, looking for it to come down and then to rally back up. Initial we have is 21,000 or 22,000 up to 22,100 as a resistance point. I think wave three, by the way, should go through both of those. And then we're starting to look for up here. Once we're done, I can add one additional fib for the third wave, but I'm still thinking it's going to end up somewhere up in here. So just going on the minuet fifth, we have 1.618 at 22,419. Then I have minute wave 5 being 100% of minute wave 1 at 22,818. These are starting to get into my levels of where I believe this third wave of intermediate degree can finish up. And that's going to be 22,818, 23,102, 23,220. I think this is going to be the cluster that we get up into. And as this matures along its way, we'll be able to fill in all of these gaps and kind of tighten it up to one area or the next. Over in the NASDAQ futures market, it has been a wild, wild ride. I'm going to go start right here on this hourly chart. And here's the 4, and there's 1, there's 2, there's 3, there's 4, and we're in minuet wave 5. Now, I have tangled, I have tossed about what all of this is. And at best, 3, 3, 3. And I think if we're really looking at the minor fifth to be a diagonal, then I think there's a fair chance that the minuet wave fifth can be a diagonal. And maybe that's what's just finished forming. This was a dynamic rally up to 21,908. And then it just tossed its cookies and came flying back down 200 and some odd points immediately. And so I thought, okay, that's significant in terms of what it did and what it reached. But the follow through to the downside was just as significant to take note of. So, but I think what we've got is the possibility that we're going to be jamming, having a triangle inside of a triangle. And it would be befitting that this fifth wave blows off even more inside, and that it should start to expand. But we'll have this, and then we'll run additional fibs running up to show the final steps. Now, what does that suggest? Well, as soon as I can get a wave 2 in, again, I'll start running. Here is something that we need to take note of. I'm going to go over, I'm going to go to the NASDAQ. And so we can see right in here. See, it's not as heavy. The S&P is way ahead in the roll than the NASDAQ is. So the NASDAQ started, but we will not roll out to the March contract until the volume, basically the March contract, is greater than the December. I was going to tell you that the bulk of everybody who trades it has moved out to March of 2025. Now, accordingly, there should be approximately, and I'm going to give you the exact because you know how I am about all that. We have the close in the March was 22,046. And I'll even do that 50 cents, we'll do the change. And the close in the other one was 21,760.50. Nope. 20 minus 21,760.50 cents. And what we have is $286 worth of premium as of Friday. And as that clock ticks to March, it will get smaller, smaller, and smaller until these two are actually, this will be congruent with the cash market. Anyway, we see that starting. It is getting itself going. I'll be paying close attention. But Thinkorswim, which is this platform that I'm using, they often, well, I come in on Monday and they've already rolled. They're already rolling out to March, and that's what's going to be on the charts, the continuous chart, which is what I use. So what do we got? 286 points on top of whatever we're seeing. So 286 points, just if we're adding it to Friday's close, which is 21,760.50, is going to equal 22,046. So we may, if they do it, suddenly this is going to end up here. And then we have to make all the adjustments to it. So when you're thinking about, well, how's the market on a futures basis going to get above 23,000? Here's how. It's going to be basis a March contract versus the December contract. It's something that we need to get used to, but it's something that happens every 3 months. So we make the adjustments. And so we got to get ready to do it again. And just remember, it's only a number. That's why I do stick a lot of times with the cash. At least once a week, I'm updating the cash and get it congruent with what the future is doing. It's because if they go divergent, that should not happen. One way or the other, it will get itself corrected. Okay, so but right now, I'm kind of looking at the concept that maybe, just maybe, this is wave one, and it's a 3. A, B, C, 3. And we get an ABC down for 2, and then an ABC up for 3, an ABC down for 4, and an ABC up for 5, and we're done with the minuet fifth, we're done with the minute fifth, we're done with the minor fifth, and we're done with the intermediate third. And how glorious is it that we go out in a triangle inside of a triangle, a diagonal inside of another diagonal. So we've been diagonaling on the minute and the minor degree. So minor wave 5 is diagonal, and now minuet wave 5 is turning into a diagonal. I think. I'm going to kind of leave that as is. Our markers for the whole second wave is that, well, we pretty much, we can come down to 21,630. And then right below that, I have 21,582. But that could be a C wave. And if we got down there and it held, that worked. And then right below that, we have 21,564. So in between here, okay, those both work. 50 and 62% for wave 2, that works. 786 can work as well, along with 1.618, and that would be 21,471 down to 21,433. Here's what it cannot do. A second wave cannot close below the starting point of wave 1. That's 21,352.75. Close below that, it's not a wave 2. It's going to be something else. So that's what we're going to be paying attention to and keeping our eyes on. So right now, I'm going to be looking for it to come into here or down into here to hold and then start to rally. I'll be able to fill in the blanks in terms of where the fibs are going to come in. Once we get the system in terms of the Thinkorswim or TradingView or whichever product you're using to chart with, that once they go and they roll, you're going to know it because you're going to come in and go like, wow, I didn't think the future closed there. And it did, just in a different month. Okay, so let me take this out to the daily. Let's just take a look at our moving averages, which actually are not all that bad. And here they are. Here's the 8. We still, in this decline, didn't reach the 8. And now the 8 is still pointing higher. The 20 is still pointing higher. The 50 is still pointing higher. Not with as much intent as the 8 and the 20, but still steady, still very steady with an upward bias. So I think we have more upside to do. And that's actually where I'm going to leave all of this for right now. And next week, in terms of our numbers, we have a lot of the PMI coming out. And then, of course, Wednesday of FOMC day. So Wednesday, the 18th, we're going to hear from the Fed. So there might be a lot of volatility and just a lot of moving around in anticipation of that happening. Okay, so this is where I'm going to complete it. And our next daily update will be on Monday, December the 16th.